Thank you, Mr. Chairman. Kind of curious, who determines the rate for the swap lines, interest rate?
The interest rate is established by the Federal Open Market Committee in discussions with the foreign central banks. Obviously, they have to agree to the rate that we are willing to
How often is it reviewed to go up or down? How often do you review that? Quarterly, semi-annually, once a year?
Well, the swap lines are outstanding. For example, the current set of swap lines are outstanding until February 1st, 2013. But we certainly could review them at any.
The rate doesn't float?
At any point in time. The rate is set at essentially at the federal funds rate plus 50 basis points. So right now, it's about 0.6%
okay.
Interest rate.
But the amount above the Fed funds rate, that stays constant for the entire length of the swap, or do you float that or adjust that as well?
It had been at 100 basis points
right.
over the federal funds rate up until last fall, and then we lowered that spread from 100 basis points to 50 basis points. And the reason why we lowered that rate is that European banks were reluctant to use the swaps because they felt that using the swaps at that rate would be a sign of weakness, and so the swaps were actually not being very effective in containing pressure in financial markets. So a decision was made by us and the foreign central banks in which we've engaged with the swaps was to lower the rate from 100 basis points over the federal funds rate to 50 basis points over the
If the European banks felt it was in their own best interest not to borrow money, not to swap, because the rate was too high, why would you want to entice them into this with a lower rate?
They were reluctant to use the swap because they felt that if they used it, it would be a sign that they were a particularly weak institution.
Why are they not viewed as weak now? Because they're using it now.
Because when the swap rate was lowered from 100 basis points over the federal funds rate to 50 basis points over the federal funds rate, it became broadly attractive to the rates that were then in place in markets.
It made them look like better investors? It made them look like better investors, better money managers?
It made them, there was an economic rationale for borrowing from the swap lines at the lower rate, so lots of banks participated, and since lots of banks participated, there was very little stigma from participating in that program.
This whole thing is held together by confidence and perception that that everybody's doing okay, isn't it?
Well, I think we've seen both in the case of the swaps and in the case of our own discount window in the U.S. that there's times that banks don't want to use liquidity facilities, backstop facilities, because they're afraid that it's going to show that they're weak relative to other institutions, and that's just a problem in terms of these type of liquidity facilities.
I'm just kind of curious. I follow up on Chairman Paul's line of questioning with regards to loaning, or the ECB loaning it to the banks, and the banks turn around and loaning it to our American, I guess, companies and investors here. Why would they do that? Well, why are they not borrowing the money from us directly, our banks here?
Well, the European banks have, big books of business in the U.S. in areas, especially in areas like trade finance, project finance, reserve energy. They lend against oil and gas drilling, energy reserves. And they have specialized expertise in these areas, and so that's why they undertake this business around the world. And in the U.S., when they partake in this business, they do it in terms of lending dollars, because obviously that's what the currency that we do business here in the United States. And so they have a need for dollars to be able to sustain that business.
So what you're saying is that there are banks in Europe that are better experts at lending in certain areas, certain fields, than we have lending institutions in this country. Is that what you just said? I'm
saying that there are European banks that are specialized in certain areas. Now, whether they're better or worse than the U.S. banks that participate in the same areas, there's some overlap in terms of competitive, in areas of competition. But there's certain areas where European banks historically have concentrated their lending. Project finance, trade finance, and energy reserve lending are probably three of the most predominant examples.
Now, do the American corporations or entities that borrow from them, are they buying goods and services from Europe then? Are they buying goods and services someplace else in the world, United States, or is it kind of work like our export-import bank here, or how does that work?
Well, I would presume that if you're borrowing in dollars, you're using those dollars to buy U.S. goods and services. Otherwise, you wouldn't need the dollars. You'd need some other form of currency.
Congressman, if I could add, we're in the middle. This is a very global financial system, and we're in the middle of a very global economic system. So, large banks operate all around the world and compete with each other. And that actually ends up being beneficial to non-financial
Well,
corporations.
I understand that, Dr. Kamin, but I'm trying to get at, I'm kind of concerned here because we have foreign banks that are apparently competing against American banks, was what you just said, yet we are loaning money through the ECBA, or excuse me, through the ECB to those banks to be able to loan back and compete against our banks. Is that what you just said?
Well, what I said was just that both financial institutions and non-financial institutions compete with each other all around the world.
Yeah, but my concern is that if we through these swap lines are funding these international banks and they are in turn competing against our banks, I don't think we need to be doing that. Do you?
Well, the primary concern of the Federal Reserve in setting up the swap lines was to maintain the flow of credit to American households and firms. That was key because that's what's needed in order to maintain the economic recovery and to move toward achieving our dual mandate of both price stability and maximum sustainable employment. So that was the critical factor that motivated.
Yeah, I mean, I think the U.S. banks also are interested in having a healthy U.S. economy, just like the European banks are. And I think that they probably broadly recognize that a forced liquidation of assets by European banks would have, negative consequences for the U.S. economy and for their banks.
I see my time is up. Thank you, Mr. Chairman.